Ladies and gentlemen, a warm welcome to everyone joining us from across the globe. I'm delighted to welcome you to our session, Future-Proofing Real Estate Investment, Place-Based Risks. My name is Takahiro Yamada, Senior Analyst in the City Division of the OECD. For several years, the OECD has advancing the program on decarbonizing buildings in cities and regions, which has examined a broad set of themes essential to the building transition. The first phase explores the pivotal role of cities and regions with a multi-level governance framework. The second phase went deeper into multi-level governance through practical applications with a case study on the Netherlands that highlighted effective collaboration between national and subnational governments. The third phase broadened the scope from operational carbon to whole life carbon, covering emissions from material extraction, construction, innovation, and demolition. And this year, we entered a new phase with the launch of the Future-Proofing Real Estate Investment Project. Its goal is to help align private investment with climate objectives. As most investment in buildings is made by private actors, mobilizing private investment for sustainable buildings is essential. And buildings are not only physical structures, but also financial assets, and safeguarding their value from transition and physical risks contribute to the stability of the broader financial system. Against this backdrop, the OECD established a task force bringing together governments and a wide range of private stakeholders to examine how climate-related risks are managed and how policy can better align private investment with climate goals in real estate sector. As you may have noticed, our work strongly resonates with that of GlobalABC and the Cool Coalition. In 2024, the French government and the UNEP hosted the Global Forum on Buildings and Climate, where nearly 60 countries endorsed the Declaration of Chaillot. The declaration, especially Section 4.5, 4.6, and 6.2, underscores the urgent need to redirect investment flows toward climate-resilient, near-zero emission assets. Our project responds to this need with concrete policy recommendations. Today, we are pleased to share our findings and recommendations. We are also glad to welcome leading practitioners who present advanced examples from government and the private sector. I hope today's session offers useful insights and inspiration to advance future-proofing real estate investment. Thank you so much. So from here on, my colleague Jisoo Yoon will take the lead. Jisoo, the floor is yours.
Good morning, good afternoon, everyone, and thank you so much for joining us today. My name is Jisoo Yoon. I'm a policy analyst at the OECD. Very pleased to present the key insights from the OECD's work on future-proofing real estate investment, place-based risk, ahead of the full report that will be released later. What I will share today draws on the policy highlights, which is already available, as well as the broader evidence base that underpins the upcoming publication. Let me begin with why this topic really matters. Real estate is one of the sectors where climate-related impacts and economic exposure meet directly. Across 34 of the 38 OECD member countries, property assets are valued at $111 trillion, almost twice their combined GDP. For households, real estate is a primary source of wealth. For cities, it shapes local revenues, infrastructure needs, and long-term resilience. Because buildings are fixed in place, they are exposed to, first, climate-related physical risks such as floods, heat waves, storms, and wildfires, and second, climate-related transition risk, which depend on local building codes, regulation, infrastructure, and planning decisions. Climate-related risks already are quite material. Annual economic losses globally range from 50 to 430 billion US dollars, with spillovers into property values, lending, insurance, and public finances. A defining feature of climate-related risk is that they are very location-specific, both physical and transition risk. The Paris metropolitan area, for example, the map on the screen shows that the share of residents living in areas exposed to what is called a 100-year flood. To explain simply, a 100-year flood zone is an area with 1% chance of experiencing a major flood in any given year. It does not mean, however, a flood happens only once in every year. It describes the probability. The variation across Paris is striking. Some municipalities have a very high share of residents exposed to this 1% annual flood probability, while others only a short distance away have almost none. This reflects differences in topography, exposure, and land use and development patterns. This example shows the broader reality. Climate-related risks, both physical and transition, vary dramatically from place to place. Understanding these local differences is essential for planning, investment, and risk management. Real estate is not a single actor. It is a complex ecosystem. As this figure shows on the screen, the sector spans development, construction, property management, leasing and lending, insurance and reinsurance, certification and climate risk analytics, portfolio and asset management, and research institutions. Governments at all levels also play a central role through planning, regulation, and public investments. Because responsibilities are so distributed, no single actor can future-proof real estate alone. This system's complexity is precisely why the OECD created the Future-Proof Real Estate Task Force Group to bring these actors together. Therefore, our analysis is grounded in two complementary pillars. The first is, therefore, the task force group. This expert group met 4 times in 2025, bringing together governments, investors, insurers, banks, data providers, academics, and civil society. These exchanges helped identify emerging priorities across regions and across the value chain. And the second is the OECD Future Proof Real Estate Investment Survey. We collected responses from 48 institutions across finance, insurance, and real estate. The survey highlights the practical challenges that actors face, especially in assessing climate-related physical risk, meeting disclosure expectations, and assessing reliable data. Together, these inputs form the analytical foundation for findings that I'll present now. Before we go into the finding number 1, let me just frame again the central question which is guiding our work. The question goes, how can countries manage place-based climate-related risk in real estate while ensuring that the sector decarbonizes, withstands climate impacts, and remains financially viable? Finding number 1 is that climate-related risks are still not sufficiently visible. Climate-related risks are not yet embedded into planning or investment decisions, and urbanization continue to expand into high-risk areas. The survey helps understand why. When we asked about the main challenges in assessing climate-related risk, physical risk, 58% cited the lack of granular asset level data is number 1 challenge. 49% pointed to inconsistent or unreliable methodologies. 28% mentioned unclear regulatory requirements. These gaps mean that climate-related risks often remain partly invisible, weakening long-term planning and investment signals. Therefore, governments can embed forward-looking climate risk assessment into land use planning, zoning, permitting, and building codes. The market trigger points such as sale, lease, and mortgage renewal can be used to collect these granular data to disclose hazard exposure and energy or carbon performance. And the finding number 2 goes that data and disclosure remain fragmented. Risk assessment and disclosure frameworks differ significantly across markets. 44% of institutions identified misalignment across framework as a key barrier, and 35% pointed to insufficient data at relevant scales. Governments can support open, interoperable data sets at both the asset and location level. Shared definitions, consistent matrix, and forward-looking scenarios improve comparability and reduce uncertainty. Climate-related losses are rising, placing pressure on insurance systems and raising concerns about affordability. Therefore, linking finance to decarbonization and resilience is instrumental. Risk transfer tools such as parametric insurance, catastrophe bonds, and other instruments can improve liquidity after disasters, but they cannot substitute for reducing underlying vulnerability. Therefore, governments can link finance to decarbonization and resilience by aligning public budgets, physical tools with long-term climate objectives while enabling private capital to scale preventive investments. This includes concessional or low-cost loans, green mortgages, pooled retrofit funds, and resilient-focused financing structures. And the core principle is simple: finance risk reduction before hazards occur. Climate risks are global, yet assessments and disclosure practices remain fragmented. Even reference frameworks such as TCFD, IFRS S2, and GF scenarios are applied inconsistently. Governments can therefore strengthen international coordination, promote shared reference points, and align terminology, data classification, and performance matrix. This improves comparability, investor confidence, and supervisory oversights. To conclude, future-proofing real estate investment is essential for protecting communities, safeguarding public budgets, and maintaining financial stability. The OECD will continue this work in 2026 and beyond. The Future-Proof Real Estate Task Force will therefore expand next year, and we warmly welcome new participants. If you're interested in joining or learning more, please feel free to reach out to me directly at my email address. And with that, I very much look forward to the speakers who will follow. We have an excellent lineup of speakers today, bringing perspectives from banking, government, insurance, and real estate investment, who will share concrete cases that speak directly to the challenges and opportunities highlighted in our findings. Thank you so much.
Dear delegates, good morning. My name is Kalliopi Papadaki. I'm an architect engineer specializing in urban design, and together with my colleague Mrs. Kalliopi Kouloupaki, attorney specialized in urban law, are here today to present the policies and initiatives aimed at mitigating climate risk in real estate investment decisions promoted by the General Secretariat for Spatial Planning and Urban Environment of Greek Ministry of Environment and Energy. Naturally, climate change has affected Greece, and it is cause of the phenomena such as rising temperatures and drought, which in turn cause extreme events such as fires and intense floods. The above, combined with other parameters related to the country's relief and the wide island area, the long history of its settlements, and its economic profile related to the tourism sector, led the General Secretariat for Spatial Planning and Urban Environment to promote a series of strategies concerning urban areas and settlements that affect the shape and the real estate landscape, the most relevant of which are the National Strategy of Urban Resilience, National Strategy for the Management of the Housing Stock, as well as the urban resilience plans that will be drawn up by the municipalities. In order to be effective, the above was of course combined with financial tools that allow the implementation of the relevant action and measures. One of the most important is the Recovery and Resilience Funds, through which the Ministry of Environment and Energy issued an invitation to all municipalities and regions of the country to submit funding proposals to the intervention aimed at improving the public space program. In addition, it's important to mention the successful participation of 6 Greek cities in the European mission for the 100 climate neutral and smart cities by 2030, as well as the creation of a corresponding Greek network in which approximately 100 Greek cities participate and which is promoted and funded under the responsibility of our ministry. It is understandable that all these actions that create more resilient and upgraded urban environments affect real estate values in an upward way, and it's a real bet to activate balancing mechanisms that ensure affordable housing, something for which there is a combined action by many co-component ministries. Let me now give the floor to Mrs. Kouroupaki.
Thank you, Mrs. Papadaki. Dear delegates, good morning. I will continue by outlining the main legal and policy framework that govern Greece's initiatives for mitigating climate risks. Let me begin with Article 24 of the Greek Constitution, which highlights the protection of the natural and cultural environment as a fundamental obligation of the state. Next, the United Nations Framework Convention on Climate Change. Greece ratified the convention through Law No. 2205 of 1994. Also important is the 2030 Agenda of the Sustainable Development, in particular Goal 13, which calls on us to take urgent action to combat climate change and its impacts. Finally, a key element of the European level is a recently adopted EU Regulation 2024/1991, which sets out the strategic direction for climate adaptation and resilience. The mitigation of climate risks in Greece is achieved through specific urban planning tools and legislation, notably regional spatial frameworks and local and spatial urban plans. Currently, 227 local urban plans are underway, covering 80% of Greek territory, along with 18 spatial urban plans in development. These plans identify local strengths, opportunities, weaknesses, and threats, define prevention and emergency response strategies, temporarily delineate streams in areas under urbanization, assess geological sustainability for construction, integrate climate adaptation measures, include disaster and emergency management strategies, compliance with a recent local or special urban plan ensures that any property located within this area is already aligned with resilience standards, as climate risks have been considered in the spatial planning process. The building code also includes critical provisions for construction safety. In addition, the fire protection regulation for buildings aims to ensure public safety during fire incidents, while the fire protection regulation for properties located within or near forest areas focuses on enhancing resilience against forest fires. Compliance with these regulations guarantees that appropriate technical and construction measures are taken to address risks such as fire, flooding, and other climate-related hazards. All these policies and frameworks mentioned earlier provide access to critical data and risk maps, guide the selection of suitable sites for development, inform the technical design of projects, including materials and construction methods. As a result, they reduce investment risk, set new standards for sustainable and climate resilient real estate development. So, the best decision is the one that is fully aligned with the relevant policies, laws, and regulations. Thank you for your attention.
So I'm Thomas, I'm part of AXA Malts, and thanks Takahiro and Yeso for the respective introduction. I'm honored to be here and be representing AXA Malts and our approach with respect to physical climate risk, as well as the work that we're doing with the IIGC as part of my role as co-lead of the adaptation and resilience track. So just a word about AXA EM Alt. We're overseeing around 111 billion of real estate, and we are covering under real estate equity mainly Europe, around 77%, and the rest of the equity asset is located in Japan, Australia, and US. So that's the background I'm talking from. I will be focusing on physical climate risk specifically, and I'm happy to take questions in the live Q&A. So just to start and remember what's the respective basis, it's about the impact of climate change on buildings, and that's causing the industry to move forward much more rapidly, especially in line with the long-term holding periods. So the basis remains the changing frequency and severity, which is causing different kind of chronic and acute events. And the impact on buildings is both structural, internal, but it can also have a dedicated impact on the occupants, which we should not forget, and that's crucial as part of the work that we're doing with IAGC, is to push forward to the system-based thinking, because from a building owner perspective, we're typically looking at the building itself, but we should not forget the disruption and the impact in terms of potential injuries, health, discomfort or productivity on the respective occupants. And that's why it's crucial to look at that as well. So I just wanted to remind everyone what we see as key drivers in terms of the push to better incorporate physical climate risk and the respective assessment in the industry. So that to us is threefold: operational, regulatory, and non-regulatory. From the operational side, as you've seen, due to the impact, which are physical in nature, we need to assess physical climate risk at entry, so in transactions during ICs. We need to assess it for our standing portfolio, and we need to assess it as well at the start of a development or a redevelopment as a dedicated trigger point to ensure that we prepare for the impacts of climate change and we integrate in the design stages the actions to adapt to the respective physical climate risk exposure. In terms of regulation, there are several drivers for our portfolio. The most advanced is the EU taxonomy, where there's a dedicated appendix that outlines what kind of physical climate risk need to be assessed. And then there are also other drivers that we see in the market, as well as on the client side, but also key frameworks. We've translated these requirements into dedicated requirements. So the ones that you see on line 1 and 2 are from the respective EU taxonomy. So as you see, there is a dedicated list of risks, which I will show next, but there are also requirements of how you need to assess physical climate risk. And when you are reviewing tools, there's a lot of tools that do not meet those respective requirements. And what is key is that you also adapt the choices that you make to the respective asset class and the lifetime of that activity. And for real estate, typically they're looking at around 30 to 50 years as an average lifetime, while you can also take longer projections. But this is the minimum which is outlined. And in terms of physical climate risk projections, in terms of scenarios, you need to apply 4.5 to 8.5. So we've translated this into an RFP when we were selecting a new physical climate risk provider in the past, but I will come back on that later. In terms of the kind of risks that need to be assessed, so again, here you see the split between chronic and acute, and these are the risks outlined in the EU taxonomy. It looks quite scary, but it's less scary when you assess, one, the materiality for the respective asset class of exposure. In my case, that was real estate, and then the relevance for your portfolio, which is dependent on your geographic exposure. We've translated that in what are the crucial risks for a certain provider, and then we've done a mapping in the past of the typical solutions we were working with, and we've seen, okay, there was a gap, so we've used those gaps and those lists as a key requirement. So I will talk next about the assessment that we did, because there's a lot or many climate risk providers available, and we've implemented an RFP evaluation criteria checklist based on 5 key categories. So we wanted to assess and get a tool with highest granularity, maturity, accuracy. We wanted to get a maximum of financial outputs, but also dedicated outputs to allow compliance with the regulatory and non-regulatory requirements. We wanted to ensure that we have a maximum asset coverage. What do I mean with that is from an asset class perspective. If we wanted to expand it to other asset classes, that was possible. Geographically as well, that's where the checklist on the previous slide comes in. But more importantly, that the platform and in terms of display and functionalities, that it allowed use by the different teams that we want to have involved. So the people who are actually managing the assets, that they are also able to work with it, because we need to move away from centralizing everything in one central ESG team to bringing climate change and the respective impacts and the management thereof with people who are actually managing the respective assets. We've also identified several attention points, but I will come back to that later. Here you see a few of the providers that we have assessed. So we assessed a total of around 30 solutions at the time. I didn't rank them here to not offend anyone in the room or watching this online, but we've seen significant differences from one player to another, and we've basically reviewed these based on our respective needs. But again, the market is evolving very rapidly. So what for us was key is that we not only assessed these tools, but we also tested the ones that in the end we shortlisted based on our requirements, and that's where a sample analysis came in. And what we tried to do during this sample analysis is we gave them the same list of assets. We asked them to conduct for the risks that they all had available, the same kind of scenarios, the same projection periods, and what we saw in terms of outputs that there was differences from one provider to another. So this is quite a barrier to making decisions, not only here when we were selecting a solution, but also later what you need to be aware of when basically doing an analysis, that there's a lot of dependency on the tool that you're using. So in the end, how did we make a choice? We moved forward with a provider that had the widest coverage, met the best on our different requirements, but was also willing to pop open the hood and to show the data that they were using, that was willing to engage with us, with whom we were able to challenge the data, and also where we were able to conduct additional bespoke modeling. But this to me is a key point. There's a lack of harmonization when it comes to metrics, definitions, and even scope of hazards, which needs to be addressed, because otherwise it's garbage in, garbage out, and you cannot make appropriate decisions. Going beyond the data, that's where physical climate risk assessment or appraisal methodology, or in short PCRAM, comes in. That is a methodology for which we're collaborating with IIGC to adapt it to the real estate industry through a respective case study. And for that, we're also collaborating with MOTMAC and our physical climate risk provider, Swiss Re. And in short, there's always 4 key steps. This ensures that the industry is looking at things in the same way and allows you to assess physical climate risk how it makes sense, meaning that you look at the different steps independently. You differentiate between exposure of your assets, which is purely your location, and separately the vulnerability, which is dependent on asset characteristics, but also the actions that you have already implemented. Then it's about assessing the actions you can take, and also the last step, which is key because we're still financial institutions, is the economic and financial analysis. It's assessing what action makes most sense at what stage. And that's where separate variables come in that we've identified for real estate. There will be others, of course, when you're looking at a different asset class. But due to the nature of real estate, there are several variables that have an influence and that need to be detected early on in the assessment, because they will influence the way that an asset or a portfolio is going through it. This might be the level of control, the length and type of lease, the age of an asset, the investment structure, because all of these aspects will have an influence what kind of decisions you will make, but also what data you have available. And the earlier that you map your portfolio, the better that you're able to go through the different steps. A key thing, and that's where I will end on, is also that this will have separate effects. And we need to also move towards more of a system-based thinking, where we differentiate between, okay, what is the impact on the building and what is the impact on the respective occupier, because that might be completely different and it will have nonetheless an important consideration. And that's why in PCRAM there's an important aspect which is called system-based thinking, where you map the connections between different supporting systems, but also see who is impacted most, but also who should be taking certain actions. So for example, for certain exposures and the respective effect, there might be more of an impact to the respective occupier in terms of business interruption than on the landlord or the owner, but also in terms of taking certain actions. Part of the actions required might be with the local municipality or even the government, and cannot be taken by the landlord, where you would be more focusing on engagement. And that's why it's key to approach this from a system-based context and move beyond just looking purely at the physical asset as a standalone component. Thank you, and happy to take questions during the hopefully live Q&A.
Well, good morning, Brazil. This is René Meijsberg from ABN AMRO, and I'm heading the valuation department within ABN AMRO, and also in Europe. I have some different roles in valuation and ESG, climate and environmental risks. And I would say something about the DUPA. It's a Dutch term, but it's the sustainability paragraph. And it all matters about the ESG, climate risk, price into the market value within valuations. And that's what I would like to say to you today. Well, what's the goal of the DUPA 2.0? The primary objective is to ensure that appraisers incorporate sustainability, ESG factors, and climate risk into the determination into the market value. That's what it's all about. And the key points are that appraisers are required to provide an independent market value based on their expertise. And as per today, it's very difficult for them to do that and to combine all those factors within the valuation report. That's the reason I was the initiator and started the DUPA 2.0 3 years ago to provide a structured framework to assist appraisers not only to describe sustainability, but also convert that into the market value. That's why it really is important. And today I will show you some best practices, something about the processes, and also how to proceed with this. Why DUPA 2.0? Well, first of all, and you all know that because you're all in the sustainability area, it's very important to have the intrinsic motivation. But unfortunately, we all are aware of that not all people in the world have that motivation. And therefore, it helps a lot that there are regulations. And regulations, we have that all over the world, but in Europe, we have the Paris Agreement 2030. You all know about that. Also, including, well, let's say the Climate Act in the Netherlands. And, well, that's all the measures which are important for the upcoming years from now on to 2030. And then the bold one is that as a good example of regulations which helps the market to change and to show leadership in that. And what we see here is that, well, all office buildings must have at least an energy label C per January 1st in 2023. And having said that, all of a sudden, the 2 years before that, all the owners of office real estate, they started to improve their buildings. And not per se because they have the intrinsic motivation, but they were obliged to do that. Because if they haven't, it wasn't ready at January 1st, they could not longer letting their office space. So that's a very good example of how regulation helps us in the world to do something about real estate, ESG, and also the climate risk. And of course, we have a lot of guidance and requirements regarding ESG, climate risk for the banking sector, such as the ECB, ABN in the Netherlands, our national instructor, and also the AFM. And even more, there are also there's specific guidance and requirements also via the valuation sector, via EVS, AVS, RCS, EVS, and Tagova. Well, a lot of terms here, but basically they are the policymakers within Europe, and they all changed their policies earlier this year, and it's all in the policy framework now, also from the valuers, that they need to not only say something about the risks of climate risk and ESG, but also convert it into the market value. And that's applicable both for residential real estate and also for commercial real estate and corporate real estate. So basically for the whole sector. Well, what's specifically required then for DUPA 2.0? First of all, and that was a very tough cookie to arrange this, it's that we ask, besides the market value, which valuers are well happy to do that because they do that for a long time already, but we ask the market value with a special assumption based on the fact that the property is upgraded to at least an A label. And then you have some measures you can take, and that's the first thing. And secondly, it's of course, well, that's the $1 million question. What's the impact on the market value? And that's the real change. And to be honest, DUPA 2.0 was most of all change of behavior and leadership, because there was a lot of resistance for DUPA 2.0 in the Netherlands. But then we convinced during roadshows all in the Netherlands to convince all the valuers this was really the way forward. And it was implemented in 24. Now we're 1.5 years later, and almost every valuer is doing this. And then next to that, so we asked the valuers to provide the market value considering those ESG and climate risk factors, such as in addition to the traditional factors such as location, construction, and condition. But that's very important, the change. Also keep in mind and do the qualitative analysis first, and then the quantitative analysis to determine the market value. And that's where we have created for them to help them the DUPA 2.0 framework. Now, now we are 1.5 years further, and we convert already DUPA 2.0 into DUPA 3.0. And we are also mentioning the fact that, it's very important it's not the DUPA, because we want to roll out it all over in Europe. So we now call it the ESG data set, because that has a broader perspective than only DUPA, and we can use that all over Europe. And we have the advantage in the Netherlands that we're not only working with software providers such as Kate and Flux, but also with the real estate taxonomy. Well, the VT17, that's very technical, but it means that it's very important that we have uniformity of the data. And that's really necessary if you want to use a global standard. And that's the reason, we are heading in the Netherlands concerning to this topic, ESG integration. That's very important of doing that. And now we're going for the next step. Only this week, we had a huge meeting, and we are investigating further integration with INREF, RCS, Dutch Banking Association, and combine it all to the new ESG data set, which we can not only use for valuations, but also for reasons of reporting, because we all need to do reporting as well on ESG and climate risk. Well, this is quite high over. Now we go into the details. This is still in Dutch. I will do that, but on the left you see also the English translation. These are the data points for the DUPA 2.0 concerning the climate and environmental risk. Well, you can see that, and you get the slides afterwards. But anyway, you see a lot of data fields into the depth, so you know something about which are the current fields which are being used. And it's even smaller on the next slide, but anyway, this is all to give you a glance what data fields are used in data in DUPA 2.0. By the head, there are 84 data fields, and some of them were already in the valuation reports, but others are new here. And then, it's even worse to see. But anyway, you will receive those slides. This is also in Dutch, but it gives you an overview of what the additional fields will be in DUPA 3.0. I want to highlight some fields here. For instance, for trees, we have the 330-300 rule. If you have trees around you, you are happier as a human being. Sick rate is lower if it's an office, and you will be happier, and therefore it has a certain value. It's hard to describe in detail, but that's one of the fields which I would say it's good to highlight. And it's also, for instance, another field is solar panels. It can help you as well, and lots of more examples. I can elaborate more on that. So those are the fields. And if you have any questions, I summarize them. You can liaise directly to me via LinkedIn, give me a call or an app, or send me an email, and I would be happy, together with all the other people who are speaking here, to give it a follow-up. Thank you so much.
Good morning, good afternoon, good evening. My name is Lee Wolfram. I work for the Capital Markets and Financial Institutions Division at the OECD, where I work for something called the Working Party on Insurance and Pensions, where I focus specifically on natural hazard insurance. So today I'll talk a little bit about some of the implications of climate change for insurance markets, as well as some possible solutions for real estate owners in dealing with the challenges that insurance markets are likely to face. So you don't have to look very far to find media about the impact of climate change on future insurability, whether you look at insurance sector media, academic literature, or even global economic and financial publications like the Financial Times. There's clearly increasing concern about the impact of climate change on the future availability of affordable insurance. And there are some signs of affordability challenges for both households and businesses. So, for example, in Australia, one analysis found that 15% of households could be affordability, or are currently affordability stressed, I should say, in terms of a measure that they came up with of insurance costs relative to household income. In Canada, in some of the most wildfire-exposed cities, insurance costs have increased by more than 50% since 2023 in some of those most exposed cities. In Europe, EIOPA has found that more than 25% of households or businesses in 6 of the 17 EU countries for which data was available, people felt that natural hazard insurance had become unaffordable. While in the United States, the cost of household insurance has increased by more than 40% since 2019. The graph in the middle is actually a picture of the situation for businesses. So this is from a broker whose clients would normally be medium or larger businesses seeking insurance coverage. And basically what it shows is that over the last 5 years or so, there's been quarterly increases in the cost of property insurance at the global level, with the exception of the last few quarters, and sometimes significant increases in the range of 20%. And while this is of course a challenge and of course substantial, it should be kept in mind that part of this increase is related to inflation, which has been high, not as high as the insurance price increases, but has been high in a number of years in the last few years. So basically, when you're thinking about addressing these insurance market challenges and specifically enhancing affordability, there are 3 main ways that I think can be that can be used to achieve this. One is looking at things that are around innovation and competition. The second is about diversification, because ultimately insurance is basically an effort to diversify risks, and the more diversified the risk, the lower the cost of protecting against that risk. And then finally, by reducing risk, which is really the most sustainable and most effective way of reducing insurance costs over the longer term. So one of the approaches I'd like to mention is something that's being established in more and more countries, which we refer to as public-private insurance programs. And they do a lot of things, but one of the things that they do is they help create a large and diversified risk pool within the country, whether it be by providing reinsurance coverage across the country through a state-owned reinsurer, such as in France, whether it be direct insurance through a state-owned insurer, as in the case of Iceland, or a specific program for some natural hazards, which is provided by a government agency in the United States. Ultimately, we found that these kinds of programs have supported broader insurance coverage by making it more affordable, ensuring it's available, and also by encouraging take-up. A second area that could have an impact on the affordability and availability of insurance in the context of a changing climate is alternative risk transfer innovations, and I'll talk about a few of them. The first one is parametric insurance, which is basically insurance that's provided based on a pre-agreed parameter that acts as the trigger for the insurance payout. It's often used to address gaps or to supplement conventional insurance. It's not usually used as a substitute for traditional indemnity insurance. It can have some benefits, including in terms of potential cost savings, at least in theory, because ultimately the insurance company does not have to assess the specific vulnerability of the policyholder or the impact that the event has had on the policy. All that they really have to think about is the probability of the event occurring in the first place. And then one of the challenges is that because it is event-based, there is a risk that payouts will not actually reflect the losses that are incurred, and which is referred to as basis risk. So the easiest way to look at this is if, for example, an earthquake of a given magnitude occurs, that's if it's just below the magnitude at which the parametric insurance coverage, it might still cause the same level of damage, but a payout would not be provided, which is of course a risk for the person seeking financial protection. The second category of alternative risk transfer I want to mention is catastrophe bonds, which are basically a financial instrument that transfer catastrophe risk directly to capital markets. So most of the issuers of catastrophe bonds are insurance and reinsurance companies, although there has been some use by governments, particularly in emerging markets, and also by some non-financial corporates. These instruments can provide some flexibility in terms of setting out the design of the protection that's needed and provided, how remote or how low probability the protection is. These bonds can provide a significant amount of funds, but they can also involve significant initial costs, as they are quite complex instruments requiring the establishment of special purpose vehicle, among other costs. And finally, another innovation in insurance markets has been the development of captive insurance arrangements. So basically, captive insurance arrangements are basically in-house insurance companies that are set up to manage the risks at the level of a corporate group. Basically, it allows corporates to increase their retention by sort of pulling together risks from across the group, and to access reinsurance markets directly with a pool of more diversified risks. The interesting thing is that there are an increasing number of countries that have established regulatory frameworks for captive insurance arrangements, and there's a growth in the use of these types of arrangements among corporate entities. And together, I think the important thing to remember is that all of these alternative risk transfer approaches, while they might have different uses, benefits, and risks, they all create competitive pressure on conventional insurance markets and act as a bit of a counter-cyclical mechanism to deal with fluctuations in insurance markets and ultimately, hopefully, keep insurance affordable and available. The most important of all the measures that can be taken to address affordability challenges is, of course, risk reduction. And ultimately, well-designed insurance arrangements should encourage risk reduction. We looked at this issue a couple of years ago in terms of how the insurance sector is contributing to climate adaptation specifically, and how they could actually enhance that contribution. And we basically looked at 4 different services or benefits that the insurance sector can provide. One is in developing the natural hazard and climate risk analytics that the insurance sector uses to underwrite insurance coverage, but also to manage its own financial exposure. Second is to incentivize risk reduction by households and businesses by providing pricing that reflects risk, providing discounts when risk is reduced by the policyholder, providing information and advice and expertise on how policyholders can implement effective risk reduction, and also by supporting resilient reinstatement after an event has occurred, also known as Build Back Better, which is usually one of the most cost-effective times to intervene and actually build resilience. I will stop there. Thank you very much for your time, and I hope this was of interest to you. If you want to find out more, I've given a link to our website as well as my contact details, my email. Thanks very much.
Well, thank you so much for all of our speakers. And now I would like to open the floor for the Q&A session. So for those who are joining us online, please feel free to drop your questions on the chat. And I invite all the panelist speakers to turn on your camera so that we can actually have discussion. Thank you so much. And while we're waiting for the questions to arrive, I would like to actually start by asking our panelists whether you have any questions or reflections for another. Please, if you have any questions, feel free to turn on your microphone and then start jumping in.
Well, I will start then. Renier to Lee. What is really the largest challenge you are facing currently?
For me, the largest challenge? That's directed at me. Yeah, so luckily I don't actually face any challenges because I've just talked about the challenges that other people face. But in reality, yes, I think one of the most I mean, climate change is really causing a lot of countries to re-examine how the role of that insurance is playing in protecting people against these losses, people and businesses, and in a lot of places you're seeing that insurance isn't really achieving, insurance markets aren't really achieving broad market or broad coverage, and governments are trying to look at how to intervene, and as a sort of an institution that generally works with the market, it's a bit of a challenge to try and figure out all of the things that you can do to get the market to be able to achieve the coverage without all of it falling onto the balance sheet of the government by taking on this risk. So it's quite a challenging time, and it's also quite interesting because there's also, on the other hand, some arguments as to maybe this insurance for these kinds of risks is actually something that should be a government responsibility ultimately because of things like past land use planning. So it's, I don't know, maybe I turned it into what's the most interesting thing about it, but it is a challenging time for governments, I would say.
But only for governments or also for the private sector? What should you do?
No, absolutely for government. I mean, ultimately, it's the households and the businesses that are having challenges that are in accessing this coverage and paying for this coverage, and so that our focus is really on helping governments ensure there's an environment that basically makes these markets work. And so I focus on the government challenges, but ultimately the challenges are on the plates of the corporates and the households.
Thanks so much for the question and the answer. Well, I actually have a question for all of you because the upcoming report and also the policy highlights that we just released, we actually point out the importance and also the lack of the interoperable data. And this is something that Thomas also highlighted in his presentation. So in that case, I think that data is really the common language that goes through all sectors in the climate risk assessment in the real estate sector. So what is the single most helpful change, either it's regulatory or market driven, that could make actually the climate risk data easier for you in your respective sector, to use and share? Thomas, actually, we cannot hear you.
Now I hope you can hear me.
Yes.
So from my side, happy to kick off. I think the key thing will be a repetition of what I've mentioned during the presentation. This regulatory remains the basis and remains the driver. So on the one hand, it is taxonomy such as the one we have seen in the EU, because it is ensuring that the market moves into a certain direction. But besides, it is also what is happening on basically the non-regulatory side of implementing minimum standards, standardizing the language which is applied in the industry, but also forcing to look into one direction. And the other hand, it is about our job as an asset manager for value retention on the longer term, especially for our clients, and doing what makes sense. So for us, it is the combination of both, regulatory being the minimum basis, but also going beyond, especially for traditional asset classes.
Thank you so much. Any other reflection on data?
I would say we need to have validated data because we see a lot of data flow coming into all kinds of systems, and once it's not has been validated, it's very hard to use that, and then you come to conclusions and they are based not on validated data. So I would say that's the biggest challenge concerning data on the one hand. And then, for instance, we also need uniformity, because you can have data points, but if you don't use the same metrics to use that, that's also a problem, because then you can have validated data, but you cannot compare the two data providers to each other. And that's not helping as well. So in my view, those are the two important challenges on climate data for the next years.
Thank you so much. Lei?
Maybe it's actually because I'm definitely not an expert on this, and I look at it from a different angle than you both. But I wonder, is there any risk about, because you talk about harmonization, and I can see the benefits of the harmonization, but is there any risk to dependence on sort of one single approach or one single? Maybe you're not talking about harmonization of model as much as harmonization of output, but is there a risk that everybody relies on the same model and sort of acts in the same way? This is sort of a theoretical financial sector stability type question in many ways, but is that a risk?
Yes, that is a risk. Although working in the financial sector, we have also, well, let's say the party from Frankfurt, the ECB, to be more specific. And well, for instance, if we will work with a data provider and it's called like an index or a model, we need to do model validation. And well, we have a bunch of smart people who are able and capable of doing that. So yes, it's a risk, but therefore there's a process in place which has been forced by the ECB that's obliges us to do the model validation. And of course, well, we would say that's sufficient to close that gap.
Great. Thank you so much. And I see that we're slightly over time, but unless there is a last minute comments or reflections that you would like to address, maybe this is also a good time actually to call it an end. And this is not only the end of the session on the real estate, but we're actually almost towards the end of COP30. So I really hope that everything that takes place in Belém right now wraps up really well. But even though the COP30 wraps up, the issue that we're discussing on the real estate is still a big challenge that every day that we all face. So I wish that we continue this conversation more in the next COP as well. And also, again, I thank all the speakers and panelists who participated from different countries today. And I wish you a great afternoon and good morning. And then we will keep in touch and stay safe. Thank you so much.
Thank you.
Thank you. Bye-bye.
Thanks, everyone.
Thanks.
Thank you. Bye-bye.